Hello and welcome to another episode of Your Retirement Planning Simplified. I'm Joe Curry, along with my co-host, as always, Lindsay Wilson. How are you, Lindsay?
I'm great, Joe. I'm always plugging theater on our podcast, but just gearing up for rehearsals with Fourth Line Theater in Millbrook for a show, Jim Watt's Girl Reporter, that'll be up in August. So, wanted to put in the plug. But yeah,
Sounds
excited
good.
about
I
that.
can't wait to
Yeah,
see it. Also, and I think a lot of our listeners like to know what's going on with your acting, so it's all good. Plug away.
yeah. And how are you, Joe?
Everything's good. We so obviously we're doing these intros after we record the podcast. So jumping right into that, our podcast today, it's a long one, so we will keep the intro brief, but we talked to Mark Hebner of Index Fund Advisors, and he's got a wealth of experience around evidence-based investing, and I think that all of our listeners are going to get something out of this episode, so I'm really excited to get that message out there.
Yeah, he's the founder and CEO of Index Fund Advisors Incorporated and author of the highly regarded book Index Funds, the 12-step recovery program for active investors focused on investor education. He's also a respected speaker, frequent news contributor, and authority on investing. His life's mission is to change the way the world invests by replacing speculation with education. And he's especially knowledgeable about index funds, portfolio construction, and the research indexes designed by Nobel laureate Eugene Fama and Kenneth French. Just so that we'll expand on what that means. These indexes provide the building blocks for the prudent evidence-based investment strategies that Hebner implements for his clients. So right up our alley.
Yeah, he's doing the exact same thing that we're doing, but he's put out so much content and education around this, and he's had a huge impact on a lot of other, not only investors, but other advisors too. So anyway, I think everyone's going to enjoy the episode. Hey, Mark, welcome to the show.
Hey, thanks, Joe. Good to be with you.
All right. Well, I'm excited to have you on. We just had a good chat before we jumped on here, but you've been talking about index funds for a long time now, and I'm excited to get some of your, I guess, thoughts on the subject of evidence-based investing, so that our listeners, again, are getting some information from a good source rather than just kind of our everyday media and whatever's popping up.
Sure.
So maybe you could start, though, by telling us a bit about your background and just kind of what brought you to the investment industry. We'll start with that.
Sure. So by my first education, I'm a nuclear pharmacist. A nuclear pharmacist is somebody who dispenses radioactive pharmaceuticals to hospitals and clinics. And we built a company, my partner and I, right out of college. And over a 10-year period, we built that up to some 450 employees and 35 or 36 locations around the U.S. And we took that company public. So I got my first exposure to the public markets a little bit. Then we had an opportunity to sell it. And in particular, for me to sell my shares because we wanted to merge with this other company and the other guy wanted to be the president. Anyway, so I retired at age 32 with this huge windfall of cash. And so I talk about this not to brag about it, but actually to show you the opposite, because I was unlearned about investing. I really hadn't taken any time to study about investing. So at age 32, 1985, I received about $6 million. It was more than that, actually, because we did 2 transactions, but it was a big chunk of money. And I was cold called by a broker out of one of the major brokerage firms because they monitor those kind of things, especially for public CEOs. And he, talked me into investing with him. And, you need to diversify, you need some guidance, blah, blah, blah. And so, okay, yeah, we'll throw you some bucks. Anyway, fast forward about, 13, 14 years. And somebody calls me up and they figured because I was a businessman, an entrepreneur, I would know about investing. And they wanted me to help them. And I thought, well, I felt really responsible. It was a woman, or actually she had been widowed. And so I said, well, I would really like to help you. And quite frankly, I'm not sure what's going on with my own money. And I've had this sneaking suspicion that something wasn't quite right. So I said, you're going to give me the impetus to really start to dig into this and sit down and read some books. So I went to the local Barnes and Noble, came out of there with 22 investment books, started plowing through now famous books such as A Random Walk Down Wall Street. In fact, I have them in the back of my book here, a list of, I think, 28 of them that I think are my favorite. How many? Oh, no, there's 35 now. So, I mean, some of my most favorite ones is A Random Walk Down Wall Street. Later came A Little Book of Common Sense Investing, John Bogle on Investing, Bogle on Mutual Funds, basically all some of the classics on passive investing. And I also picked some books up about active investing. But as I started reading the two, the thing that really hit me is here I was a scientist, a nuclear pharmacist, and we had been reading journals, the Journal of Nuclear Medicine, and basically learning about evidence-based medicine. Okay. And so when I first discovered that there was evidence and journals about finance, I was blown away because I never even knew about it. I thought you went to Wall Street Journal and you watched, the CNBC, and you go to Barron's and you get your ideas and run out and buy the hottest investment, right? So, and listen to your broker.
Yeah.
And so after reading all these, I thought, what the heck is going on here? People can't beat the market. They can't pick stocks. They can't, time the market. And there's this entire industry, literally 98%, 99% at that time of the industry was actively investing with people's money. And then I thought to myself, what the heck? Why would people do this when the evidence is so strong? And so I went to Yahoo. There was no Google at the time. And I typed in stock market gambling because I thought maybe it's just kind of a gamble. It took me to the New Jersey Alcoholics Anonymous website. And there on the side was a little tab that said stock market gamblers. I go, what? I click it. And here's a whole list of things in a little brochure, things that were, take a little quiz. Do you monitor the market a lot? All the signs that you might have a gambling addiction to the stock market. Of course, not all traders are addicted to gambling, just like not all drinkers are addicted to alcohol. But you dabble in there, and especially if you do well, I like to tell my clients, you want to go out and gamble, pray that you don't do well. Because when you do well, you're going to want to put more and more money in it. And then all of a sudden you'll learn about market efficiency and all the mistakes that investors make. So that led me to telling my friend, well, the way you should do this is, to passively manage and buy index funds. And then I talked to a few other friends and I just sold a second company, and hardly anybody understood this. Vanguard was out there pumping the story. And I thought, and I had also been investing as an angel investor in web startups. So I thought maybe I need to create a website to put all this evidence out there, make it clear to the world, and provide a questionnaire about how much risk is right. Because when you finish studying all this, what you realize is that your returns are not influenced by your speculation. It's more about how much risk you take.
Yeah.
Now, actually, it might be influenced to the negative with your speculation, but returns are driven by risk. And so probably the most important question about your investment design and portfolio is how much risk is appropriate for you. So I created this risk capacity survey, put it out there. People would answer the questions. And then at the end, we'd ask for their name and phone number, email. And to my shock, we're getting like 10, 15 people a day filling out this form. And it was 49 questions at the time. It was 1999. And so that was kind of a screener, if you will. Someone had to be really serious about getting some help about investing and sharing their information. So that kind of led me to the creation of IFA, IFA.com, and got me started in the investment industry.
Okay. Now, that's quite the story. And I think it's really impressive that you found that so quickly, kind of right off the hop. You found evidence-based investing.
Yeah,
And I would say, like, I hate to say this, but I would say probably more than 50% of the advisors I know still don't know what evidence-based investing is.
it's probably more.
It's probably more. I'm trying to be generous.
Well, plus you've probably attracted, as friends and acquaintances, those who do.
Sure. Yeah, exactly. Now, why do you think that is? Like, why do you think that like advisors on the whole are still all in on active management, like on a large proportion anyway?
So when I get into a debate sometimes, I pull up Upton Sinclair's quote, which is, to paraphrase, it's really hard to get somebody to understand something when they get paid a lot of money not to understand it.
Yeah.
And literally the entire industry that we're in is based on a transactional type of business model where the more trading there is, the more profits the companies who provide these investments, these brokerage firms in particular, big banks up there for you guys, the more money they make. So it is literally the business model to find a salesperson who will move people around from one investment to the other or sell them on an investment that pays a large upfront load, carrying fee over time, a quarterly 12B1 fee, and the full alphabet of different trailing fees. And so it's really sort of anti-investor, the typical source of advice, which is primarily brokerage firms, especially when I started, 25 years ago. Today, finally, the word is starting to get out that there's another way to get advice, and that's from, at least in the U.S., what we call a registered investment advisor. What do you guys call yourself as a classification up there in Canada?
We have like PM firms, portfolio manager firms. And then so to be able to do like discretionary investing, like there's some specific credentials you need to have as well.
Right.
And then we have like different levels of broker dealers. Like you guys have broker dealers. We have like independent broker dealers, or we have like broker dealers tied to some of the big companies, right? Like the Manulifes of the world, things like that.
Sure. Well, one of the big points of division is whether somebody has a fiduciary duty
Right.
to their client or not. And that's always a little bit of a shocker when you try to explain to clients that this broker that you're working with is not required to be your fiduciary, and so therefore not required to do what's in your best interest. They have in the U.S. what we call suitability standard.
Yep.
And so this was a shock to me also when I figured out, because I had all my money at this brokerage firm. I mean, that's kind of an interesting story also. For 12, 13 years, I had the same broker, and we're calling and talking about our kids and our family and, buy this and buy that and sell this and sell that. And at the end of the whole thing, when I figured out, I didn't actually tell that part of the story. I figured out after this 13, 14 years that it cost me about $30 million versus just owning the S&P 500 over that period of time, which was one of the few indexes that were out there in 1985. When I got this money, there were just starting some firms like Dimensional Fund Advisors, who started in 1981. So it was right after they had first started. But that really got me going, thinking about there was a better way to do things. And I was young, I was 32, so I probably could have handled the volatility and the risk of a full equity portfolio, at least for a while.
Yeah.
And we actually have in our website, an index calculator that reduces the risk over time by 1% a year reduction in equity. We call it the glide path. It's kind of like a target date fund. And we actually do that for clients. And then we can build that into our analysis. So you can put it in there and say, well, let's say you started at 100% equity and it reduced by 1% per year. So For me today, that would put me about in a 60-40 portfolio, which is probably not too bad for a 70-year-old, 71-year-old. And so not knowing or not hiring somebody to help me was a really expensive lesson. I guess the only good thing that came out of that is I was able to create this firm and help sort of battle this active management industry, which I've been quite active in doing, and trying to clean up something that's really not good for retirees, which I see that you're focused on retirement, which is pretty much the goal of investors saving up money, either maybe college planning and retirement planning are two of the biggies.
Yeah, and I would say that obviously it's probably a pretty tough pill to swallow when you figure out kind of what you maybe missed out on. But I have no doubt that you've helped other people more than make up that $30 million in their own portfolios just from all the information you've put out over the years.
Well, thank you. I've tried.
Well, I think you're still doing a good job. Now, is there, so you read all these books, is there anything that really stood out to you that really convinced you that the passively managed kind of portfolios or strategy made more sense than active management?
Well, I think the basic premise had to do with that I discovered is whether the prices of securities were overvalued or undervalued. That's really the goal of the active management. And the third option there is that they're fairly valued. And the conclusion of these academics, Eugene Fama and Paul Samuelson, and a number of academics who looked at this topic, basically concluded that the market price was the fair value of these securities. And the way that was the what we call the price discovery system leads us to that conclusion. You have roughly 5 million buyers and 5 million sellers in the world, all looking at, I don't know how many stocks we're down to. It's maybe 10,000, 13,000 worldwide. And it's just not that hard to look through all these stocks with computers. And so when the sort of compromise between someone who thinks something's a buy and someone who thinks it's a sell, when they meet, they arrive at the fair market value. And so if that's the case, that the whole world is looking for under and overvalued securities, when in fact they're all fairly valued, you quickly come to the conclusion that everybody's pretty much wasting their time picking stocks and timing markets and maybe even picking investment styles. I want to be in small cap now. I want to be in growth now, large cap value, whatever it might be. So, I think that's your answer.
Yeah,
I think that it does. Now.
No, that answers the question, but I'm going to have you maybe build on that a little bit. Maybe you could just talk to our listeners a little bit more about, what is evidence-based investing or index investing and how is it different than active management or active investing? And so we've been kind of dancing around it a little bit. Maybe we can just speak specifically to it.
Well, I think the key factor when you think about the term evidence-based investing is that you're relying on peer-reviewed academic research, which by definition, because we have these peers who challenge the assumptions made in an academic paper, and it can easily take 6 months to a year before an author goes back and forth with what are called referees who say, this data is not statistically significant, this assumption doesn't make sense to us, and going back and forth, that process results in the best information, which is in essence evidence about whatever the paper is written on. And our friend Ben Felix and Cameron Passmore have done a wonderful job at boiling down some of this academic research, and I try to do my best as well. But I think the key thing is instead of relying on the news that you see day to day and somehow thinking that that news is not already embedded in the price. That's a really important point here. And therefore, there's an opportunity for you to leverage and exploit another buyer or a seller with this information. That's what people think. The evidence is that the price is already includes all this information, and it's basically too late for you to make any kind of move, if you will, to buy or to sell, and take advantage of what you think is a future trend in the market. And the random walk down Wall Street was also one of my favorites because that destroys the trend. It's basically a random movement because the prices react to new information, and that new information is random by definition. As I like to say, it's called news. It's not called olds.
Yeah. Okay. So at the end of the day, the evidence is looking at what is that peer review evidence and how it can be applied to building real life portfolios versus what I think everyone thinks about around stock picking, that somehow we can get information before the rest of the world so that we can sell our overpriced stocks and we can find the underpriced stocks to buy.
That's correct.
Right.
And, this is Eugene Fama's Nobel Prize, just to clarify. It's called the efficient market hypothesis. And basically, Eugene Fama likes to say the simple way to think about the efficient market hypothesis is it means that prices include all available information. And so that when he says all, you better listen carefully, and he means it. He chooses his words just verbally and what he puts in his paper very carefully. And if in fact all that information is already in the price, then you should not be acting on it, in essence.
Okay. Now, I've heard the argument from fund companies, wholesalers that, you know what, we know that markets work and index funds probably outperform most actively managed investments, but retirees need risk management, right? They need downside risk protection, and that's all they're really interested in. And that's why active management makes sense for retirees. What would you say to that?
Show me. there is no data, no studies that indicate that the active managers can provide downside protection. First of all, it's a random walk, okay? The future news is not knowable. And let's just get that right for a minute. We can forecast, all right, but we don't know for sure what's going to happen. And included in this price today is this all available information, which includes all of the forecasts about what's going to happen. So if something's really obvious to happen in the next week that's been announced or whatever, that's immediately digested in the price. So for some active manager to be able to get out of the way of a down market or jump in before we have an up market is really preposterous, given the way that the efficient market hypothesis has held up for, how many years are we now on this? 40, 50, 60 years or something. It's been one of the most challenged ideas in finance, and it still wins. It still holds up. We've now passed the threshold where half of the dollars are now invested in passively managed funds. But I might add, many of those are ETFs, and those are traded like wildfire. And so it's one thing to have a passive product. It's another thing to buy and hold it passively. So, but we are getting rid of, or slowly moving towards a greater and greater amount of products being a passive product. So what's that? Basically, it's an investment that has a set of rules that are adhered to regardless of market conditions. That's kind of my definition of an index fund.
Yeah, no, that's perfect. And maybe just, I'm going to clarify for our listeners. So what Mark's saying is, it's great that more and more people are investing in index or passive type investments. But if we just try to time when to get in and out of those ETFs or funds, essentially we're speculating again and trying to pretend we know more than the market.
You're trading ETFs instead of stocks. I mean, this was Jack Bogle's big problem with the ETF. When they first brought the idea to him, he said, "This is ridiculous. Why would I want to buy an S&P 500 at 9 in the morning and sell it at 10?" And he said, when you create a tool like the ETF, you're basically creating a shotgun to shoot yourself in the foot. In fact, in his little book of Common Sense Investing, I strongly urge that people either listen to the audio version or read that book. He talks about a certain kind of shotgun, I can't remember, that was really effective. And he's saying these ETFs are basically going to be a shotgun. And I have to agree with him that these ETFs are largely traded, and I think too few investors properly purchase and hold on to those until they need the money. That's my basic advice about buying a fund: is you hang on to it. Maybe you rebalance, along the way. You should rebalance. Maybe a tax loss harvest here in the U.S. But in essence, the general idea is you shouldn't be selling that fund until you need the money.
Yeah, for sure.
Assuming you bought the right fund to begin with. If you're buying actively managed funds, get out and move into a passively managed fund, and then hang on to that, and don't be a trader.
Okay. Now, so we're talking passively managed investments, in other words, index funds. And now you literally wrote the book on index funds and making that shift over. So the 12-step recovery program for active investors. So in that book, you highlight 12 points. And if it's all right with you, I just wanted to zoom in on a few of those points. People can get the book or visit your website if they want to get all of them. But I'm just going to throw a couple out at you and you just give me your thoughts on them. So now you've already talked about efficient markets, but we still have to admit that we're powerless. So admitting powerlessness over market predictions. Any kind of additional thoughts on the efficient markets?
Well, so I'm not sure how many of your listeners are familiar with the 12-step recovery program for alcoholics, for Overeaters Anonymous, or for drug addictions. The 12 steps, I think there's about 32 different addictions that are treated with the 12 steps. And this will make number 33 maybe. But, I don't follow the traditional full 12 steps. But the first one is, if you're an alcoholic or you're a gambler, you have to admit that you're powerless over this addictive substance or activity. And but admitting that you are powerless to your market predictions, or basically that your market predictions will not help you, maybe another way to say that, is tied to this efficient market hypothesis, because all the news and all the forecasts of millions, tens of millions of people are already in the price. So you're not going to be able to make a forecast that over many forecasts will help you. We have a nice little chart on our website looking at the market gurus who forecast for a living, and none of them achieve about a 74% accuracy that's required to beat a buy and hold index fund.
Yeah. Okay. Now, obviously, if you admit you're powerless, then you need to make the decision to follow proven principles.
Yep. So that gets back to our evidence-based investing. You basically want to have some academic support for virtually all the decisions you're making in your investments.
Okay. Now, when I'm talking to retirees, I get the comment around, Joe, I understand that investing in stocks and markets makes sense for the long term, but I don't have long term because I'm retiring soon or I'm retired. So the way I always kind of talk about that is, you're kind of half right. You are retiring. You need money now, so we need to take that into consideration. But on the same hand, you might be retired for 30 or 40 more years, so we also need to take that into account. So one of your points is focus on the long term. But what would you say about focusing on the long term when we're talking about, again, retirees?
Well, when you're younger, and you have an income, you should think about two components of that income, one of which is your consumption, your daily needs. But the other one is to think about the time when people will not pay for what we call your human capital. In essence, we're renting our time to an employer or somebody who pays us. And when you're, I don't know, 75, sometimes 65. And lately, I hear a lot of the younger people today want to retire at 55. In my case, I love it so much. I think I'm just going to pass out right here on this keyboard and be done. But there will come a time where it will be hard for you to find somebody to pay you for your time. And so we call that your human capital. And then you have to switch over and rely on your financial capital as a source of income. And so that's why you have to take the latest number now is 15% of what you earn. And I start from your gross salary. So you're in 100,000, you better sock away 15,000 of that to start planning for your retirement. Now, I'm sure, I don't know if you listened to Ben and Cameron's show about all the various ways to do safe withdrawal rates and all that kind of stuff. We have a pretty simple way of thinking about that. When we look at 25, 30-year periods, we see that the single lowest period on a monthly rolling basis, if you start with about a portfolio of 65 at age 65% equities at age 65, would have made about 6% in the worst situation out of looking at hundreds of them. And so we tell clients you can spend about 6% per year based on the value of your portfolio, not what's typically called the 4% rule, right, which only looks at year one and then inflates that first year. But if you're doing what we call dynamic withdrawals, and I don't know what you do with your clients, so hopefully I'm not telling them something that you do.
No, it's all right. We do a version. Our favorite, our favorite is the guardrails. So a version of dynamic distributions or withdrawals.
Exactly, yeah. So we like 6%. Some of my advisors like to go a little more conservative and do 5%. But I want also clients to enjoy their retirement. So if they are properly invested, they've saved over their career, they should be in good shape to have that 6% replace the income they were making prior to a retirement. So does that help you? So that's kind of the long-term idea is you got to start early. You got to start with the right amounts. We call that the first order problem in retirement planning is you got to save and investing. The investing doesn't matter if you don't have savings there. And so, but also it's funny, I hear a lot about the long term lately. Everybody should realize that the long term is made up of a bunch of short terms. And so generally what applies to the long term in your thinking should apply to the short term.
Sure. It makes perfect sense.
Yeah.
And maybe this kind of can speak, or that speaks a little bit to the next point, but what's the importance of utilizing professional guidance, or where does that professional guidance come in to help people, especially as they're approaching and entering into retirement?
So I think every investor should think about whether they get a professional to help them or not, just like they think about so many other activities in their life. You might read a few books and you might have some information about investing that gives you some confidence. But I got to tell you, I've been doing this 25 years. I haven't met, I can't even think of one person who really understood this from soup to nuts. And writing a book, you really get to learn a lot.
Sure.
And there's just so much that goes into this. And one little mistake could have a substantial impact on your long-term building of your wealth. And if you're taking a percentage of that in your retirement, it literally can have a large negative impact on the amount of money that you will be able to live off and enjoy in your retirement. And so sometimes I just don't understand why someone would be willing to pay to get some help. What they tell me is, well, I already know this. You're going to buy index funds, no big deal. But there are just so many other aspects to this, in particular, the complexities of financial planning. This gives a comfort level. And sometimes I think of the fees that they pay an advisor is almost like an insurance premium to prevent themselves from making mistakes with their investments. In 2008 and 2009, so many clients, even clients of ours, we couldn't get to stay in their portfolio. And we fought and talked to them until midnight sometimes, trying to educate them as to why that was the best thing for them to do. And I often thought about the investor who didn't have anybody to talk to, who probably sold out after they had lost 40, 50% of their money, and then were scared and couldn't get back in. And so they pretty much just took a loss and probably never recovered, 20, 30% of the money that they would have recovered if they just hung in there. And so that's an extreme example, but there are a lot of smaller examples along the way that are really critical to investors. And find yourself somebody who really understands the evidence, the academic research, who you can trust, who you feel confident working with, and get some help. This is just too important for people to try to do it on their own.
Yep. No, I agree 100% on all of that.
Well, we're biased, Joe.
We are a little bit.
We are
very biased.
we make a living out of doing this, so that should be obvious to everybody. But I think it's important to say. But I have to also say, at my age, and I'm 71 now, it's a little different for me. And when I first started out, we didn't have any assets, and I felt a little more salesy about my discussions. Today, I feel almost more fatherly about my discussions and just wanting to help people and ensure that they get on the right path. We have $5.3 billion, I think this morning, close to the $5.3 billion. And so at this point, another client almost is invisible to us. Market volatility can go up $30, $40 million in our assets. Yeah. And I've shifted from just wanting to help people instead of, as opposed to just generating, an extra number of dollars in fees per year. And so it's, I hope that helps some of your listeners to come to a conclusion that they should get some help. Now, I think we should add, Joe, though, not everybody in this industry is going to help you. And in fact, I don't know what the numbers are. I would say 95% of advisors could actually make things pretty bad for you. Could actually be worse than just buying, a simple total market index fund and hanging on to it, assuming you would do it. But what you want to avoid is people who don't understand what we've been talking about today, which is this passive investing with both passive funds and passive holding on and rebalancing your portfolio. Because if you get somebody who's going to generate a lot of transactions, put you in high cost funds, it could be actually worse than you reading a bunch of the books that I've told you about, including my book that summarizes all these other books, and really spending some time to understand, what we've been talking about. That could be better than going to a broker who wants to trade stocks and time the market for you.
Yeah, that's fair. I think maybe a couple of questions to ask somebody if you are interviewing advisors is, one is, what is your investment philosophy, and can you explain evidence-based investing? It might be a good place to start, just to see what the answer is.
Good luck with that. You're not going to get a lot of good answers. We talked about that a little bit before the podcast. I'll tell you, I have trouble going to some of these investment conferences because almost everything you hear is still active investing, unless you're going to like a dimensional conference where they're having professors give you lectures as opposed to salespeople. And so the industry is still very much driven by transactions and getting people scared and then getting them greedy. Fear and greed is the salesman's tools.
Well, and I think that's a good point, because I think it is an easier story to sell, and how I'm going to protect you from, the markets going down, and we're going to find the best stocks. And that's what people want to hear. They want to know that they're paying someone to help them do better than everybody else. So it's an easy trap to fall into.
So, Joe, I've been doing this for 25 years, and every waking hour, I try to think of a simpler way to get people to understand this. Along the line of what you just said, is that active investor wants to sell those stocks that they think are overvalued and buy those ones that are undervalued. And in fact, there aren't any of either of those that we would know in advance. Okay. In hindsight, we can go back and say, oh, that thing was over or undervalued. But even that is not the case. It was properly priced given the information at the time. And I think that's a tool that your listeners can use in their mind when someone tells them to buy something. They can think, oh, is that undervalued? And why would that be undervalued? And why would someone be willing to sell it? And with all these people watching, why would this be a good buy or a good sell? And I think if you can get the strength to say, well, no, I think it's fairly valued, then it's such a mind shift to move over to the element of risk. So we didn't talk about the various dimensions of risk. You want to be passive, and then you want to look at these risk factors that explain the returns, the most basic of which is stocks are safer and have lower returns, and bonds are safer and have lower returns, and stocks are riskier and have higher returns. But within stocks, there's small and value and growth and various dimensions. That's what dimensional fund advisors is all about. And those are complicated subjects that few individual investors will ever have the time. They can't even go to a dimensional conference and learn some of these really sophisticated topics about both market efficiency and what's called asset pricing models, having to do with these various risk factors.
Yeah, so I think I have maybe two more questions for you, Mark. Oh. So one would be, and I know this is something that we talked about before we jumped on here, and something you've been trying to get out there, is the benchmarks for the indexes that people are being measured against aren't actually showing the full picture. Yeah. We'll start with that one.
So first of all, there are two return types for virtually every index that we see in the media. One is known as the price return. And one of the problems with the price return is every time companies issue dividends, at the end of one day, the last buyer gets the dividend, and the beginning of the next day, that buyer no longer gets the dividend. And so let's say it's a $1 dividend on a $20 stock. The day before, someone's willing to pay $20, but it's really $19 of stock and $1 of a dividend. Well, the next day, you don't get that $1 dividend. So the FINRA and all the regulators require the price to be reduced by the amount of the dividend. So the price immediately opens at $19. In fact, overnight, it's reset from 20 to 19. Now, the price index now makes it appear that you lost $1 and your return has gone down. The stock went from 20 to 19, and it does not add back the dividend to those shareholders who received that cash. That is a basically miscalculation of an investor's total return. And so if we looked at long-term data, just let's go to the Dow Jones Industrial, probably the most commonly watched index in the world. Yesterday, it closed at 38,834 for the price-only return. And if we looked at that return for the last 25 years, it annualized out at only 5.7%. But there were about I don't know, 2.5% dividends. So the total return was 8.2%. And the index level, they call it, instead of being this 38,300 or 800, is at 96,363. In fact, we went back to the beginning of the Dow, which was 1896, when they had, even back then, they didn't have dividends in the index. That's because it was way too difficult to calculate, right?
Sure.
Now we got computers, it can be done quite easily. If you added dividends from day one until now, the Dow should be roughly 1 million instead of 38,000.
Isn't that
So
something?
I think it's really important to investors, because if they see that these indexes with those dividends reinvested have grown so much more than what they see now, they might be more interested in being a passive index investor. Now, to your point, if you're benchmarking somebody's, let's say, portfolio of stocks, and you use the price only index, it positions the manager to be in a to have an opportunity to beat the index easier. So just as an example, if you look at the S&P 500 last year, it was up 24% as a price only return. But if we add back the dividends that were subtracted, it was 26%. So if your stock picking broker, market timing broker, earned 25%, right in the middle of there, he's going to say, look, I beat the S&P that you see on S&P on CNBC, and you ended up beating the market. Well, not really, because he didn't count the dividends. Okay. Mutual funds are required by the regulatory agencies to compare to a total return index. Therefore, I think they should also, all the media should be required to report the indexes in the total return format. And I have a little petition at ifa.com/petition. We would love to get some more signatures. We got 505 signatures now of people who would like to see this change. And I've been spending the last 4 months calling all of the index people and all the media people. And it's amazing how resistant they are to making this change. And I think they're just going to have to be pushed a little harder.
Yeah. Well, I mean, it makes sense because it's more transparent, right?
It is transparent. Maybe we should do the TSX, since you're up there in Canada, the composite. If we go back 47 years, the annualized return for the price only was 6.6%, but the total return was 9.9%. So instead of the 20,611 yesterday on your exchange, it should have been 87,913. And so it's just a misrepresentation of what's going on. Every academic paper, every academic you speak to only looks at a reinvested total return index for all of their research, all the factor models that we had talked about, all the Fama-French indexes, all the dimensional indexes, all use total return. And it's just the default. It's one of the reasons I was kind of caught by surprise on this, Joe, is we just always assumed everything was total return. And it was our 25th anniversary dinner we had. I was going to do a little presentation. I said, hey, look at how the S&P's changed from 25 years ago to today. And my data gal comes back to me and she says, Mark, do you want the price return or the total return? Well, of course I want the total return. She says, but that's not what you see on TV. I said, what? So that's how this whole thing started. It was just crazy. And I'm a little embarrassed because here I am, index fund advisors. I had heard this somewhere, and I even heard in the Rational Reminder podcast, Sam Hartzmark talk about it. But it just kind of went over my head until I sat down and tried to look at the 25-year period in the two different indexes and see this huge gap.
Well, yeah, when you see the difference, right? It's not like it's a small difference.
It's huge.
You mentioned the factor investings again. So my last question for you is, and maybe I'll just throw out an example. So one of the factors Mark's talking about is that the evidence would suggest or shows us that value stocks or relatively low price stocks do better than growth stocks or relatively high price stocks over time. Mm-hmm. Now, that's over time. That's not in any given period. And so my question to you, Mark, is what would you say to someone who's looking at like the last 10 years where we've seen kind of a difficult period for value, that factor? Like, how would you encourage someone to stay disciplined and follow the evidence?
Yeah. So again, the long term is made up of a bunch of short term, right? And so if you were to look at the last 96 years, I think we have on this chart, how often did value do better in growth in a 1 year period? Okay. It was only 59% of the time. So only a 9% advantage in short periods, right? When we go out to 10-year periods, it's still only 78% of the time in rolling 10-year periods that we historically have seen value do better than growth. So what is that? 22% of the time? So basically 1/5 of the time, 1 in 5 10-year periods, you're going to see growth had done better than value. So, by the way, everything in markets should always be discussed in the past tense because the future is unknown, right?
Right.
So we have expected in the future and we have results from the past. But even in 15-year periods, it's 87% of the time that value has done better. And when we look at small versus large, it's only 55% in short periods. But just like in casino gambling and all gambling, there's usually a very small edge in each bet or in short periods of time to the long-term expected winner. And so in 10-year periods, a full 25% of the time, you would have been better off in large versus small. So 1 in 4 10-year periods, you're going to be better off in the one that you think has the lower expected return. And so I think I said that right.
Yeah, I think so.
Yeah, you got to be careful when you're doing these because you get the reverse in your mind.
Yeah.
But anyway, to me, the answer to your question goes back to this famous saying from this book about why smart people make mistakes, is odds are you don't know what the odds are. And so you got to get these probabilities of occurrence well understood. And another good example of why you need a professional investment advisor who's well studied in this area. But let me just add one more point. When we look at value versus growth over lots of periods, in other words, a large sample of time, which is valuable to people. A lot of people say, oh, I don't have that much time. That's not the point. The point is the larger sample you have, the better you can estimate the next event. But over long periods since 1928, value stocks have earned a 12.5% return, while growth stocks have earned a 9.5%. So a full 3% per year on average difference. Yeah. But you have to understand these probabilities of seeing what we call these premiums, these excess returns for taking greater risks. But it's risk. This is the other thing. If it was a certainty that value was going to always do better than growth, then that would get priced in and it would go away. It needs to have uncertainty associated with it. Just quickly, that premium of 3% has a 14% standard deviation. So that means 2/3 of the time, it's 3 plus or minus 14. Well, that, for those who are good at math, you're going to quickly see, wow, that's a lot of range. Yeah. And I may have to wait a while to see that. But when you understand this evidence about this long-term historic data and that the price has always been fair since 1928 till now, then you better understand that those probabilities should apply to you and your investment experience.
Well said. All right. I appreciate you being on here today, Mark.
My pleasure, Joe.
So before we sign off, can you just let people know where they can find all the great content you've put out in the last 3 years anyway?
Yeah, well, we should explain that. The SEC has this stale rule, so you don't want data that's older than maybe 3 or 4 years. They don't actually tell you what a period of time becomes stale. But so we keep all our data, almost all of it, up to date. And if it gets older than that, we take it down from our website. So our website's ifa.com, India Frank Alpha, which stands for Index Fund Advisors, ifa.com. And we've got tons of information here. We have videos, articles, charts, index portfolios with all the data going back to 1928. about those returns. We've constructed what we call the IFA indexes, which is sort of an extension of the dimensional indexes. And you can read about the descriptions there and how they're constructed. But when you have that kind of data, this is one of the great things about indexes, is it gives you more information to draw conclusions about the future. So that's why you like indexes. In fact, live returns from mutual fund managers are woefully inaccurate and inadequate to be able to draw conclusions about the future.
Okay. So to all of our listeners, we're going to have all of that information in the show notes. So ifa.com. We'll also put a link to the petition in there for anyone who wants to be able to see the total return or hear that on the media. And then Mark also mentioned some of his favorite books. We'll get those in the show notes. And anyone who wants to learn more about index investing, evidence-based investing, the ifa.com website is a great place to start. So Mark, thanks again for joining us.
And there's a contact us button up there. If you want to email me directly, you can get me on the drop down.
Perfect.
Thank you, Joe, for having me today. It was a lot of fun, and it's refreshing to hear somebody who understands all this and appreciates all this academic research.
Well, it's been a pleasure to have you talk about it because you've been doing this for a little while now, and I know your expertise is a welcome message to our listeners. So thanks again, Mark.
All right, thanks. Bye.
Thank you for joining us for this latest episode of Your Retirement Planning Simplified. Be sure to tune back in for the next episode, and until then, we're here to help you simplify and succeed in your retirement planning.